All right, well, why don't we go ahead and get started? Welcome, everyone. And for the people on YouTube, welcome to Passive Cash Flow for Life. A little background for you. So we've been doing this for almost a couple of years now. And the idea is, and we've kind of revamped a little bit lately, but the idea is to to present some information on multifamily, single family, and on notes, with the idea being hopefully we can provide some value. And then if someone feels there's value there, we've got a multifamily course and some single family stuff and some stuff on notes as well, that we can obviously help provide, I guess, education on from people that have been very, very successful in the business. And so today we have the founder, basically, Nicheole Amundsen, who started this whole thing many years ago. She's been doing, I guess, commercial real estate for about 26 years, I think. And also has done single family, also has a big note business. So she is kind of the expert at everything. So we're very excited for her to be here. She's been gone for a little bit, a couple of weeks, a month, something like that. And she said we had some questions that were sent in by some different students and stuff like that. So obviously we don't have time to go over a ton of questions, but she selected 3 or 4 of them, and then we'll kind of go through those. And then obviously whatever questions you have at the end, we can kind of take those and hopefully we can provide, like I said, some value to you guys. So Nicheole, it's all yours.
All right. Thanks, everybody. Hey, folks. So, like James said, all we're going to do is we're going to take some of the questions that people have had and just try and answer them. Most of these questions are fairly self-contained, I think, and so I'm just going to kind of present the question and then tell you kind of what I think. But then we'll kind of jump in and let other people kind of have their say a little bit too. And then if anybody has any questions that they'd like to ask, then we'll kind of we'll take those questions and see how this works. So this is fairly, kind of not planned. This is just kind of some basic information. So here are the 3 questions that actually it's supposed to be, it's 4 questions that I'm going to try and answer today. So basically, the first question is partnership structures and kind of what are some of the best practices. My gut tells me if you are new to each other, if you haven't had a lot of interaction and been around each other for a long time, the best thing to do when you start out is to do a joint venture. And a joint venture is benefit of it is it's kind of time limited, and it is for a defined project or a defined point in time, and it doesn't put you into something that if you find out you can't work with somebody that you're kind of locked in. It would be a short term thing. It's typically between 2 companies. And the key is to a joint venture is that everybody that is involved in it has to play an active role. So this is not like a syndication or a placement where you have general partners and limited partners. This is a joint venture, and everybody has roles to play, and everybody's contributing assets in some way, shape, or form. Um, and you have joint venture agreements as opposed to a operating agreement or a syndication agreement, things like that. If you are raising private money for a large deal, I think the answer probably is the first one is probably some type of a syndication, probably a specific property type of syndication where you have general partners and you have kind of limited partners. And limited partners are typically the investors who don't want to have any risk. They want to be passive. And the general partners are people who are working together, and each have a role, or each company has a role in the work they're doing. All right. Any questions about partnership structures that you would like to ask? All right. James or Jane, do either one of you have anything to add to this?
So I would just say, and you may have touched on this. I'm sorry, I got a message from someone. And if you did, please tell me. But I think that um, any kind of partnership, at any point, I think you need to get everything written down and agreed upon in the very beginning. Did you touch on that?
No, I did not.
Okay.
That's a good point.
So, people just change, money changes people. Or sometimes you don't know somebody that well or whatever it is, and then you thought they were going to do X amount of work and they don't, or whatever it is. So I think it behooves you when you're going into a partnership, even as Nicheole mentioned, it's just for one deal, right? Hopefully you're not going to get in a partnership and say, hey, we're going to do this for the next 40 years unless you really, really know the people. But I think if you have it all in writing, then there's really no, I mean, there's still going to be some, discussions, if you will, but I think there's less, room for someone trying to change something because you're like, hey, listen, we agreed on this beforehand. It's right here in writing. I think it makes the partnership go a lot better from the very beginning. And people don't take advantage of each other if it's in writing most of the time. So I think that's a good, thing to do. But Jane?
Yep, you stole my thunder with the in writing, and very detailed in writing too, and then make sure some of that stuff. And we found working with some people, um, people are just different and they expect different things. My work hard is different than somebody else's work hard. My show up is different than somebody else's show up. So we typically have a harder time working with people because they don't work as hard or do what they're supposed to, I guess, with some of the real estate deals we've had. But or some people are just if you don't clear out your emails and you all have the same email, that's one person wants them all cleared out and erased every day. Another person will keep them in there for a little bit, just little things, and then over time that becomes bigger things. And um,
So
yeah,
any partnership structure, excuse me, joint venture, syndication, whatever it is, needs things in writing. And so that's inherent with what I'm saying about partnership structures, joint venture agreements, whatever is, it has to be in writing. But you also can't get every little thing written down. And so you also have to have open communications, and have some agreements as things start coming up. So we all have a tendency to, because you don't want to step on anybody's toes, to not say anything and to just let things slide a little bit, or to, it's not worth getting upset about. But really, the longer things go on, the more irritated it makes other people. And so better to just get things out there and talk about them first thing early. The other thing is that once you start getting actual properties, you need to make sure those paperwork are in order too. And that is, so you may need to make sure that the deeds are correct, that things have been filed. And so there's also a lot of paperwork on the back end to make sure that everything is in order. And you, even if you're great friends, this is business, and you need to make sure that you're taking care of the business, right? All right, so next question is, if you're just starting, what is recommended regarding number of doors? At what inflection point do you need more resources, etc.? That is a very individual question. And it's going to be hard to answer it for everybody. There is no one answer to this. So what I would say regarding this is that if you're talking about commercial real estate, you probably need to start out thinking, kind of what do you, or if this is residential, what is it that you want? What's this going to do? Is this going to replace your income? Is this going to be an addition that you're going to hold on to some properties until you're getting ready to retire and then you have that additional income? What is it that you want to do? So if you were, for example, need, I'm making this up, $8,000 a month to pay your bills, right? Just to pay your bills and stuff, then you need to figure out that each property initially is going to cash flow somewhere around $100 a month per unit. And that is, a lot of times in first year, it's not going to make that. If you have partners, you're going to be sharing that income with partners. And so you need to think about this. But if it was just you and you need $8,000, that means you need 80 units to replace your income. I think maybe the person who was asking this was thinking about when you're first getting started, you're going to manage them yourself and you're going to do everything yourself. And you can certainly do that. If you're doing this full time and you don't have a W-2 job or something else, you can probably fairly easily manage 50 to 100 units yourself, even if they're single family. But the downside is that most people don't really know how to be a property manager, don't know what it takes to be a property manager. And because they don't know, they tend to make mistakes. And that's what takes a lot of new investors out, is that they just get really frustrated and they don't want to be a landlord. So I still think one of the things that worked for me, because I was working full time when I started investing, is that I couldn't manage myself. And so I had to learn how to manage property managers. And to make it the business success through other people. And my bias is that that's still probably the best thing to do, is that it's a special kind of talent, or it takes a fair amount of practice to be able to be successful at managing properties. And if you want to keep these long time, you need to be successful at property management. In the long run, I think it's probably more important to have good property management than to buy them well. And that's just my bias, and I know it is. So so let's just leave it at that and let anybody come in with specific questions related to this, and kind of see where we are, what specific questions you may have related to this. And Jane and Sharon, do any of you have anything you would like to add to that?
I think that's one of the things I wish we would have did early on, was reverse engineer what we were looking to make. We kind of, because we retired, we had all this time, and then we were learning a bunch of new stuff, and every little thing we just kind of ran off, and it wasn't as much shiny penny syndrome, whatever that is, but more we got excited about learning stuff. We didn't reverse engineer what we wanted to make, to say we need to spend this much time, this many offers, whatever, and then then it's kind of just, you're doing it as a hobby and not a company. So it took us a little bit to do that.
Do you still manage your own properties, or do you have property managers?
We're mostly seller finance, so, and then it just goes through the bookkeeper and
Okay.
a
James, have
little
you got,
to manage.
Um, it's interesting because I think a lot of people come up specifically like you just talked about. Okay, I need 8 grand a month, 10 grand a month, or whatever that may be. And they focus so much on that, that it can get a little bit disillusioning if you don't get there as fast as you want to. So, I've always thought that if you set up a system, right, and then you just kind of work the system, you'll get your goals, but you don't have control, as much control as you would like when a deal comes in, but you do have a control on how many phone calls you make, how many deals you underwrite, how many LOIs you send in, and that kind of thing. So, I would just say whatever your number is, kind of set up a system that you think can get you there, and just make sure that every week, whether it's 5 hours or 10 hours or 15 hours, just no matter what, kind of get it done, and just stay consistent.
I think that's good. That's good advice. So, yeah, what inflection points do you need more resources? So that can be property management, it can be other people's money. But that's also something to think about while you're fairly much going in. All right, so the next one is, once you narrow down what city you want to search for apartment deals, how do you identify the right neighborhood and or zip codes to target if you've never visited the area before? So this one to me is, if you know the market you are interested in, right? If you know the city or the area, most of the time we are not talking about investing in really big cities in kind of primary markets, because that's where a lot of the big boys are that are happy with 4 to 5% return on their money. And so I don't know that I think this really it is very important in the scheme of things. If I decided, I'm making this up, that I wanted to invest in Charlotte, North Carolina, for example, I'm going to look all around Charlotte, North Carolina. And when I see deals that come across that I'm looking at, I'm going to do some analysis of that neighborhood, of that market, in that market, to see if this is a place I want to invest in. So I'm not going to start out by trying to find zip codes or areas of the city. I'm going to probably start out by identifying the city and then looking at any deals that come my way. And if one of them happens to be in, when I start doing, crime analysis, when I start doing kind of looking at the markets and what kind of buildings these are, it's my due diligence, my early due diligence, that is going to decide whether I want to proceed with this or not. Because I may be cutting out deals that that would work, because I have decided that I'm going to limit myself to a few zip codes. And if you are in smaller markets, typically, it's you're going to need to do that kind of market analysis anyway to see if that property is in a location where you want to invest. And if you've been on these calls before, you know that I'm a proponent, if you're fairly early, of starting in smaller markets, tertiary markets, small secondary markets, where this doesn't really play very much, the neighborhoods or zip codes. So I wouldn't really try and identify below the MSA market kind of thing, and then I would let the deals that come across my desk, I would do my analysis based on that address and see where I land. All right. Jane or James or Renard, anything you have here?
Well, we do a lot virtually. So sorry, James, you want
No,
to
no,
go?
go ahead. Please go ahead.
So yeah, it started as like places we had affinity for, where we had relatives, known people, somebody with boots on the grounds. But as you kind of go out a little bit more and you can see you can do that virtually, or you don't have to be there. We do the market analysis, do different areas, do crime, do schools, do all that stuff, and then kind of seek out some boots and people that you can trust to do some of the tasks for you. And again, we're not big into the cities like Nicheole and James. We like the outside markets where there's not a lot of code violations and things that are gonna come back to bite you.
I know
Good
that a lot,
advice.
I know that a lot of times I'll ask a broker, not because, it's you can ask, where should I be buying? And the broker could go, well, I've got 3 deals over in this area, so this is what I'm going to promote to them. So I usually say, here's kind of my buy box. Where should I not be looking? Won't fit there. And a lot of times I find them to be more forthcoming with, oh, you don't want to be in this neighborhood because X or whatever it may be. And if they tell me some other good places, fantastic. But at least I can cull down some of the areas, because based on what they know, it's like, oh, that's a high crime neighborhood, or whatever, that place is getting torn down or whatever it may be. So that seems to have been helpful in the past.
Yeah, I've never done that. I've just let the deals come and do some analysis based on that. Because my sense is that if you kind of limit it to a buy box, so to speak, you're
Mhm.
limiting yourself and you're limiting what you're going to look, what you're looking at.
That's a good point.
So, but either works. It depends on what you're comfortable with. But if I was getting started, I would have a broader funnel to start with, and then you can narrow it down rather than having a narrow funnel to begin with.
That's
All
great.
right.
To me, I
So,
work back with I always took the police route because that's just the police in me. So my deals that I done out of Maryland, I kind of went the police route first. I would always call once I identify or if it was a house like in North Carolina or South Carolina. I always got my crime statistics kind of first once I identified the house or the property that I was looking at, and then I would just call the local police department. And because of my background, I kind of know the pertinent questions to ask to kind of like to get a feel for the crime and, the schools and what's going on in the neighborhood. And a lot of times when they talking to a fellow officer, they tend to, be more forthcoming and giving me the kind of the real gist. And then I will follow that up with a real estate agent, a local agent, and kind of reversed and went back and got my analysis that way and did my due diligence and move forward in that manner.
so what are some of the questions you ask, and how do you ask them from the local police? That gets you some of that information, Renard.
So a lot of times I will speak. A lot of times you just not just the post officer. A lot of times I ask for the neighborhood
Mm.
communication officer. They can each agency tend to call them different. Community policing. Something to that aspect, and ask to speak to the supervisor. And once I got the person who kind of is in charge of that unit or who's heavily involved in that unit, then I will tell them, hey, I'm a local police. I'm a out of state police officer. I'm also an investor, and or sometimes I may not even tell them I'm a police officer. I'll say, hey, I'm investing from out of state, and I heard you're the person that I needed to contact. Through various channels in reference to a particular area that you may be involved in. I'm just looking to get some crime statistics on the area, and any of your part one crimes. Do you have what type of, crimes are you seeing in this geographic area? It's something that I should be concerned about. And a lot of times they'll start giving you, some, basic statistics. And when I say, part one crimes, those are when you say that to a police officer, they typically know those are your UCR crimes that get reported to the federal government. So that's your major crimes, like any of your homicides, your aggravated assaults, your property crimes, your burglaries or things of that nature, your robberies, crimes against people. And so those are the things that's going to hold your property values down, or in things that's around schools. And so if you're in a school district and you have those things coming, those things affect your property value a lot. But it also, how your resources are allocated to certain areas from the federal government based on crime statistics. So those are the things that, I look at. What are my part one crimes? Crimes against people, crimes against property, and what are the murder rate in that surrounding area of that county? And then you can get a feel for that neighborhood and what's going on there based on that. And a lot of times, depending on how big the geographic area is, a lot of police departments have their website. They have heat maps on these areas where you can click on their website and you can see the different communities, if it's depending on how big the department is. Now, if you're in a more rural area, a smaller agency may not have the technology where they have that. But if it's next to a metropolitan area, bigger city, county, that's, not too far off, then chances are you can get a lot of that stuff from their website as well.
That's great. Thank you.
You're welcome.
All right. The last kind of general question, risk management. Common risks in multifamily investments and strategies to mitigate them, such as insurance, market analysis, and property maintenance. So my answer here basically is due diligence. And all of you who've been with us for a while know that we have a very in-depth due diligence checklist. The risks are many. Not wanting to scare anybody off for sure, but there are so many different kinds of things you kind of need to think about, particularly when you are looking at a multifamily property, that that you really, most of that stuff is covered in the due diligence checklist. Most of the time, insurance isn't a risk factor per se, although it has certainly gone way up. The cost of insurance, just based on all of the our storms and all of the weather changes and stuff like that, insurance has just gone through the roof. And so the only way that would be something that you can't when I'm thinking about risk, I'm thinking about things that either I can mitigate, that I can do something to overcome, or there are things that I really just don't want to deal with. And so it's going to make me kind of walk away. The market is a big one. So when we first get a deal that looks fairly interesting, before we ever go visit, I'm going to do some fairly significant market analysis. And that includes some of the things that Renard was just talking about, where you kind of look at the crime in the area, you look at populations, you look at, kind of the statistics from the census.gov. You kind of look at the market in general. And the other thing you do is you look at some of the finances that you can get, the financial information the owner's willing to give you before you go visit. And then the other things, if you pass those two kinds of things, then the others are kind of the legal, the community, and the property itself. And a lot of that stuff you are going to do once you actually go visit, or you are going to get that information when you send out the questions you want answered to the broker and to the owner. But this one is a really broad category. And I think some of the places that I most often walk away from deals more or less has to do with the property itself, or something that I found out in the market or the community that doesn't portend well. So if I can't, the finances can make or break you. And so it also depends on how much you have to raise, and if you can make it work. And that's just, before you go visit, that's some of your the performance that you're going to be doing. So property management, property maintenance, you're not really going to know that until you get down there to visit. And so that one is not one of the early things, but it is something that'll take me out a lot of times when I start doing some investigations. So I don't know what other people do, but a lot of times my when I have gotten enough information that I have an LOI that's been accepted, right? So we've come to general agreements. Then typically about 1 in 3 properties fall out for one reason or another in due diligence. And they vary. They really vary. I can't tell you that there's one that there's one that is 80% of the time. And my sense is that if you don't really look at the overall property and all the places that you miss things, and that's happened to me more than once by just not being thorough. So to me, risk management is really risk mitigation, and that is really about doing a thorough job of due diligence. So let me turn this back over to partners, to anything. Renard, Jane, Sharon, James, who would like to jump in first on this one?
Okay, I will. Risk management for us always, in single family, I think getting the house at the right price, not over leveraging, and then, getting your people in place, team. Our biggest problems have always been property management. And then when I won't say we've ever overspent on a property, and I think that always keeps us safe just for all the stuff that will go wrong. They're typically ours being in the right market, spending the right amount of money, but property management always seemed to bite us in the butt a little bit. But listening to Nicheole and James, we've gotten better at knowing what to look for.
I guess I would just say that you have a certain time frame for due diligence, whether it be 30 days, 45 days, 60 days, whatever it is that you negotiate in your contract. And all I would say is, there's some things you kind of check off the box, right? So, okay, I looked at their bank statements, or I looked at the leases, whatever it may be. Some of the other stuff, I would keep, I guess, an eye just on the market in general, because you never know what's going to happen. And Nicheole and I looked at a property, and I can't remember where it was, somewhere in the Carolinas. And I guess we were in the middle of going through our due diligence, and it turned out that the largest employer in the town, which was a hospital. Do you remember the name of the town, Nicheole? What was it?
Yeah, was right close to the North Carolina border, and I was thinking, I don't remember right off the top of my head.
So it started with a B. So anyway,
Yeah.
while we were doing our due diligence, you can set up an actual search engine or a search in Google that every time something comes up for that particular area, it'll basically just flag you. And one of the attractions that we had was that the hospital was being bought out by a very large regional hospital, with the idea being, we thought, that they would now start bringing in more, I guess, make the hospital there larger, provide more services, that kind of thing. And then what it turned out was, that's kind of what they pitched, but what it turned out was that they were actually going to close the hospital in that town and actually move everybody over to, an hour and a half or 2 hours away, wherever one of the other regional hospitals were. So, you just got to be careful because stuff can change on you like that, especially in small towns. So I would say just continue to do your due diligence all the way to the very end.
So Emma has a question here. What type of property or community problems have caused you to walk away? And that one of the things that James just said, that was one of the things. Other things that I've walked away from was finding out that the property had a big lien on it because somebody had burned to death in a mobile home, and there was a big suit. Another one was that we're buying it was basically a self-storage property, a manufactured housing community, and a strip mall that were all being sold together. And the owner hadn't paid taxes on the mobile home, so all the mobile homes that were supposed to come with the property were sold to other people. I've walked away because a road was going to be widened in Alabama, and it was going to take off part of our property. So I've walked away because there was somebody had driven big heavy trucks over some of the properties to harvest some trees in the back of the property, and they'd crushed the septic system. So they just crushed a lot of the pipes, and it was going to have to be redone. So it kind of varies. I have walked away early because it looks like the property didn't have any, the town was losing people like crazy. And so the population was going down. So it really varies a lot. And that's why I'm not sure that I can say that there's one thing that has taken me away. It's if there's something that happens that changes my projections on how I can make this property work. And it's enough change that I don't think that it's going to be easy to make this profitable. Chances are I'm going to walk away. All right, I think, does anybody else have any other questions that they would like to ask? Here we'll have time for a couple of questions on anything.
Nicheole, I got a question.
Go
Oh,
ahead.
I'm sorry, James.
No, please go ahead.
In terms of multifamily, in in terms of the commercial space, does the commercial space in terms of office space affect multifamily? Is it a correlation to the apartments and how is it affecting demand of the market, or totally two separate?
They're totally two separate things. So when you start looking at, so like Fannie Mae and Freddie more than Fannie actually does kind of monthly market updates. And they always separate out the different big sectors in the commercial space. So they will separate out office from retail, from multifamily, from kind of miscellaneous. And the miscellaneous you can think of as, laundromats and, kind of the drive-ins for the for car washes, for marinas, those kinds of things. And both retail and office space have decreased by close to 50% in valuation. And it really hasn't affected the multifamily space in terms of purchase, although the cap rates are going up a little bit, which is always good for us. There is not enough. I mean, it's becoming more and more and more of an issue, the affordability for multifamily space. And so I think a lot of the opportunities the non-traditional kind of tip opportunities are like, you see some of these motels that when you drive down the road that are in pretty bad shape, that have been abandoned, or you see, kind of office buildings that are a lot vacant. And if you have a reasonable rehab budget and can transform those into apartments and things like that, particularly affordable, then I think there's a lot of opportunity coming down there. But I would be thinking affordable housing at this point, not the new A and B constructions, because that's just people, those are the ones that are having trouble being filled because people can't qualify for them anymore. Did that answer your question, Renard?
Yes, that's interesting because I wouldn't have never thought. Because in my travels, I've seen older motel type establishments that's vacant, unoccupied, that's kind of been left, and to transform those into maybe 1 bedroom or studio efficiency apartments, affordable housing. That's interesting.
Yeah, I think, and because a lot of them have common walls, both of them have bathrooms. You take one of the bathrooms and turn it into kind of a kitchen, and one of them into a small living space and the other the bedroom. And so you just pull two of those rooms together. I think there actually is a fair amount of opportunity in that. But I haven't really figured out what the rehab costs would be for something like that lately. James, Sharon, any other questions? Anybody? Emma? Anybody else have questions?
Emma wants to know if we have any JV opportunities now that we'd like to share with her.
Mhm.
That would be you, James. I'm kind of self-funding my deals these days.
We'll talk, Emma. I'll send you something. We can hop on a call or something like that and see what you're trying to do and see if we can't come up with something.
Okay, sounds great. Thank you.
I guess, yeah, I did have a kind of a question that maybe people want to learn a little bit more about in terms of due diligence. So you're going through your due diligence, and there are some things that you are going to go back and retrade on, and there's some things that you would not go back and retrade on. Can you talk just a couple of minutes about that?
Sure. So let's talk what is retrade first. So the retrade is the idea that after you've done some of your due diligence, you go back to the seller and you say, I need to renegotiate this deal because of stuff I found. And retraders are not looked at with favor, shall we say. So it's a dirty word to be called a retrader. And so what I tend to do, if it is something significant, and I was looking at going on. So they told me that, for example, and I've had this more than once, when I actually go through units and they've told me that everything is good. And yet when we go through the units, we find 8, 10, 20, whatever the number is, that are a mess and need significant rehab. And it's going to, cost $50,000. That I'm going to retrade. I'm going to go back and say, what you said is not what I found. I am not going to retrade something that is, $5,000 or $10,000 if I'm talking about a $5 million deal. It's something that everybody is going to, every property that you do due diligence on, you find something that you didn't expect that you're going to need to fix or to do something with. And that's why just typically whenever I'm underwriting my property, I'm going to add $500 to $1,000 per door that I'm going to have to spend when I first buy the property to just to get it up to speed. Now that's not true if I got a 300 unit. I'm not going to put aside 300,000, but I may well put aside 50 to 100,000 in kind of a slush fund for things that I just have to fix when I go in. So having to replace mailboxes for whatever reason for me has been fairly common. That they're a mess. And so I'm not going to retrade about something like that. You're always going to have things you have to fix that you weren't expecting. But retrading is for big ticket items that where it looks like somebody wasn't terribly honest about what you're actually facing. That answer that?
Yeah, I think it's great.
Okay.
Joe
Other
and Nashra.
questions?
Yeah, Joe and Nashra have a question. How to handle brokerage that does not accept LOIs, they go straight to contract.
They're not a commercial brokerage,
Or
that's not where they're really focusing.
so we kind of like ran into this as soon as yesterday, which is why we haven't brought up to you directly yet. But a property we found interesting, put in the LOI. I think we're the only person giving them offers, but they said that their firm does not take LOI. So they're like, just tell us the terms you want, we'll give you the contract. And it sounds interesting. And we can't even raise money until we have an LOI.
Yep.
So it's a tricky situation. I wonder if it's one that we should just pass.
So it is, so the first thing, how many units is it? Let me ask that first.
35.
Okay. I would, number one is that, I would say, you're not going to, I don't let brokerages write my contracts. You can give me my LOI tells you where I am in terms of my offer of what my, kind of what I'm willing to pay and my terms. And once we agree on that, then we can, if you want to do a contract with those agreed terms, we can talk about that, but I'm not putting in an offer until we have some agreement with the seller on the terms. And you need to know that my attorney is going to be that we don't do standard contracts. It really depends on what I find and what I look at. We have some standard clauses that we put into every contract, and that would be our process, is that we aren't going to sign any contract that doesn't, where we don't have our standard clauses in it. So it sounds like this brokerage is really trying to force something, and I would try, and if it looks interesting, I'd try and find a way around it without letting them, the brokerage, drive the terms of this. So,
and then what do we do about raising funds if we can't technically do that before having a signed LOI?
Yeah, you really have a signed contract before you can go raise funds. But what you can do is a prospectus coming soon, where you're going to tell people, you're going to write like a 2-pager of kind of what the property is without a lot of detail, and some general things about, I think there's some examples of some prospectuses in the materials we sent, but it is a non-specific, it's just a general. And I would send that out to everybody and sort of say, this is coming soon, we're working on it. when we get to contract and get the paperwork together for the syndication, should we send you that information? Or the prospectus, this is coming soon, give us a call if you have any interest and we can talk a little more. But you have to be careful about, what you can say until you have the entire syndication packet put together. Because it all has to go out as a whole. Did that answer that? I see confusion still.
No, not confusion, Nicole, more like processing. But I guess because there's another part to it. So the other thing is in their contract, they want the earnest deposit kind of paid to them as soon as the contract is signed, which would be hard if, if the timeline between contract signing and raising funds, I don't know if we can do that within 2 days.
We wouldn't even be able to redline their contract without putting a deposit in escrow.
Yeah, so maybe we need to like lead the terms, like maybe we need to go back, leverage the fact that we are the interested party and just be like, no, these are our terms, like try to work with us, because maybe they're being a little stubborn, I think, are they?
Well, that may be a good, because I'm not going to put any earnest money down until we have a signed contract. I'm not putting earnest money down for the privilege of sending in my edits on the contract. I'm just not going to do that. It's just, that's just kind of beyond. I haven't bought anything in about 3 years, anything big in about 3 years, so I may be behind the curve, but that just doesn't sound, particularly as cap rates are going up, it's harder and harder for them to find people who qualify to buy properties. So, but you are going to have money ready to go once that contract is finalized. And so, that is one of the things that we've typically had to put up is the earnest money. But I get it back. I have before the money goes hard, I have 30 days, 45 days to finish my due diligence. And so, it's just, it's money that I've loaned to myself or that somebody has loaned outside of a syndication agreement, so to speak.
Would they be able to reach out to the broker and say, okay, great, you're going to write up the contract. That's fine. Here's our parameters in terms of what we're going to offer, what our due diligence period is and everything else. Put that together into a contract and then send it to us. And then even if the person's saying, well, you can't make any changes until we get a deposit, I would just say, well, here's my changes. When you're done, let me know, and just not send them a deposit. Because that's crazy. They want a deposit before this contract's even signed. That makes no sense. You wouldn't do that with a house.
Well, they want it next day after signing.
After signing the contract, the actual
correct.
Final contract.
Yes.
That's pretty typical. That's pretty typical.
I think like the difference that we're running into here is that, we're used to like the LOI and then we have some time to do some deep due diligence, go through the checklist. And that's essentially what they're not allowing for. So the blocker is don't have like the signed deal to raise funds, but I guess we can use the prospectus and then the earnest deposit. I guess we can't, if we were planning on raising that too, then we don't really have that opportunity either. But do you guys typically put that up yourself, the earnest deposit, or do you raise that as well?
No, I have generally put that up myself, but then in the raise, you're raising that, so at closing that comes back to you. So, but again, I would. So you're playing kind of a balancing act. in terms of how much information they're going to give you from their financials and how much they're going to let you come look at the property, etc., without a signed contract. Which is why what I will typically try and do is get market information, get copies of some leases, find out if they have any other contracts they've signed, and then try and get some like a T12 to do some basic financial analysis before the contract is finalized. But I've run into that a lot where sellers just aren't going to give you all of their information without a signed contract. Even, they'll give you something when you have an agreed on LOI. So I would go back to the broker and sort of say, we're not going to do a contract until we have some agreement with the seller on the terms, price, closing, due diligence period, those kinds of things. And then you can start the contract, but just know that we have clauses we always use that are going to get added in, et cetera, et cetera. So, this is a broker that is kind of stepping a little bit too much into other people's business, I think.
Are they asking for a larger than normal earnest money deposit? Because even though, the norm is 1%, it doesn't mean you have to give 1%. You can do less.
Yeah, it's definitely in excess of what's market.
Yeah, what percent are they asking? Is it
10.
10% earnest?
Oh my God.
Yeah.
Earnest money deposit, really?
Yeah, but at the same time that they are with the terms that we put in the LOI, we offered like 20% under asking, and they're fine with that.
Oh,
So the numbers would work, but it's just this earnest deposit that's like really high. So it's just like, how would we navigate that? That's what we're running into.
you might want to sort of say that that you'll give them, 1% initially. And then after you've gotten some of the information, so you've gotten some of the due diligence, you'll bump that up to 5%. And then when the hard money terms, when the money goes hard, you can agree to give them another 5. And by that time you should be able to have some money. But 10% is, now I've seen some properties that are really hot topics where investors just come in and they just write them a check for 50% and before they do any due diligence and that kind of stuff. And I can't compete with that, and I don't even try, frankly. So if somebody has the money and the wherewithal and they know the market enough to know that they're going to buy it no matter what, and they want to put all that money at risk without any contingencies, I just am not going to not even going to try and compete with that. And so everything is negotiable, right? And so it's whatever you can work out, but I would not necessarily accept a 10%. They may be trying to make sure that you are not kind of a tire kicker, right?
Yeah, that's kind of the sense we got. They did repeat a couple times. We make sure our sellers have serious buyers only. So they do market it that way.
Yeah. But, you can also, just kind of, I think that's fair, but, asking 10% is significant. But because you're going to have to come up with, at least 25% down anyway through your investors pool to close on the deal. So they're just trying to make sure that you already have your act together. It's just, I think they're asking too much.
So we'll try to re-own the conversation and just, if we want to
Good,
pursue it,
Yeah,
just tell them what we need to make it work.
yep. All right, we're past 7:30. Is there any other questions there that we really need to gain? James?
Daniel says, run. The deal you guys are talking about.
Maybe.
Well, I mean, I think Nicole's point is very valid that she's always taught that everything is negotiable, right? Just because they say they want X doesn't mean they're going to get it. And especially if you're the only player in town, they're not really taking care of their seller if they all have one possible buyer and they're not willing to, negotiate with them. But no, I think those were all the questions. We are having a special for the summer on the class for those of you that aren't students. I put the link in there. It's basically passivecashflowforlife.com/summer. And we'll probably run that for the next 3 or 4 weeks. It's a pretty big discount. So if you have an interest, I would encourage you to go there and sign up. And otherwise, anything else, Nicole?
Nope, it's just that we always post these Teaching Tuesdays up on our YouTube channel.
Mhm.
And so you can look for that by the end of the week.
Correct.
All right,
Okay, guys. Great seeing
Thank you.
everybody.
All right. Have a
Bye.
good one.
Thank you, guys.
All right. Take care.